Well, welcome to the fun and mentals of real estate. I have a question of the day for you. Glenn, do you want to do it?
I want you to do it.
All right, here we go. Do you know the top 10 pitfalls that can sink your rental profits?
Yeah. There's plenty of people that get into this and don't go into it with their eyes open that lose money and lose money late in life, and we're talking about big dollars. So I'm fascinated. I know you put a lot of time in this, so tell me.
We got the top 10. Number 10.
Right.
They underestimate the true cost.
Yes.
Okay, so, it's when using that 1% rule we talked about, which I kind of do.
It works.
Right?
Yeah.
I'm like, that's a screening model. It's how I kind of initially screen.
Yes.
I'm like, I don't need to look at that. It doesn't
Big
even
picture.
get close to the
Right.
1%. But then I have to do my deep dive.
Mm-hmm.
I mean, I got to get into taxes. I got to actually call the insurance guy and see how much actually the insurance, because now, as we learned with Dan Luigi in just our last podcast.
About the insurance.
Yeah, that not only does your credit matter.
Right. The credit of the tenant.
But also now, no, not the credit of the tenant. Credit of me matters to get the homeowner's insurance, but also the building now. And a lot of the claims against the building are following the building, right? And so I got to call. I got to actually get that. I got to figure vacancy rates. When people just like, oh, it'll be rented 12 months a year. No.
Right.
No, it doesn't always happen in every year, right? And then property management, if you're going to have property management. So the numbers don't lie.
And we got to talk about maintenance.
Maintenance.
Maybe setting aside money for repairs.
Yeah. So my 1% rule, which we'll kind of talk about as we go through this, that's the model I like. It says that I have 2 months of rental income to pay my taxes, my insurance, my repairs, my vacancies. Like 2 months, and I want 10 months. I want 10% return on my money. Right? So if I'm all in for $300 and I'm on a rental property, fix up, buy, and I'm renting for $3,000 a month, that's 10 months, $30,000 a year, 1% rule, right? I'm getting 10% return, and the other things, the appreciation, the depreciation, the tax write-offs, all the things, right? Now that boosts me up, and I'm like 15%. I'm like better than typically I can do in the stock market. Because if I'm not doing better in the stock market, you may as well just go stock market. I'm just saying.
Right.
Right? You know what I mean? All right. So, you want to do number 9?
Number 9, over leveraging.
Oh,
I see this a lot where
yes.
I bought the property right, it went up in value. Now I'm going to pull that equity out, or I'm going to pull it out of a home equity in my home.
Right.
And I'm going to put it down on this new property. I do my spreadsheet. Everything looks good, except I didn't factor in that payment I have on my home equity.
And
I didn't factor in that this one is now higher. So I got to go back and redo my numbers, which is fine, because if your goal is to expand my real estate empire and go from 1 to 2 to 3, that's a good way to do it. But you still have to get your spreadsheets out, make sure, and it kind of goes back to our first one where it changes the expenses.
And you have to understand, it's just like the stock market. Some people are day trading,
right?
And so they're buying stock for a day, 2 days, a week, a month. Other people are investing for very long term. They just shut their eyes. They don't care.
We had
They're
that
not gonna do
conversation.
anything about it.
Well, if I could go back in time, back to the future, and I bought 10 pieces of rental property 10 years ago, I would have probably doubled the value on all 10.
Right. So
It's
if you have a
incredible.
very long-term goal and it makes sense to have high leverage in order to obtain them quickly, but you're, it's like I was talking to a guy the other day. He was going to get a home ec. But all his numbers were just based on just that rental property, and I'm like
$500 home equity payment.
I'm like, hey,
into
you've
it.
got to factor that in. Now you're kind of at only $100 a month profit. Are you happy with that? And you might be if it's a long term, but if it's a short term goal, and the short term goal is immediate cash flow, then over leveraging is a
pulling
bummer.
the cash out on an investment property can be expensive. The rates are going to maybe go up a little higher.
Yep.
There's closing costs, all that to consider.
All right. Number 8. Buying the wrong property. And you're like, what? Okay. I think this is maybe one of people when we talk about overanalyzing.
Analysis paralysis.
Right. When we talk about that, it's really the root of it is I don't want to make a mistake.
Yeah, you're right. And really, probably step 1, the most important thing of all of it is buying the right property.
Right. And this goes back to one of our earlier podcasts on our investment series here that talks about the right model for you. You've got to you've got to understand your goals, short-term and long-term goals.
Right.
And then, so that's one of the models is your goal.
I'm going to do this because this is what my buddy did. But you didn't realize your buddy was very handy. He could fix little things. His time was flexible. You know, mine might not be.
He may have had only a long-term goal.
Right.
Where he's only getting $100 a month, but he doesn't care because he wants to pay them off in 20 years and then retire on them. That's different goal than it may be for you. So you have the model of what is your goal and then the model of the property itself. And we talked about this. Multi versus single.
Right. The condition of that
property.
The
location. Does it need to be
a
certain driving distance from you or just in an area that really has high appreciation? Or maybe you're just looking for an area that, man, this area cash flows to no end all the time, but the appreciation's not that great. I don't care. I want cash flow.
Right.
So your model is not your buddy's model. You better get your model straight. So the only way you buy wrong is if it doesn't fit your goals.
You know, it's funny. I think almost all these could have been number one. So the next
one,
7, screening the tenants.
Poorly.
Yes.
If you don't screen tenants well, we had a great one on this, on how to screen tenants. Look at our Investor Series podcast here that we're doing on the screening of the tenants. Because, again, if you're going to go with your gut.
This tenant really feels right. Or with me, it's the emotion. I want to put emotion. Boy, this would help these people out so much. They could use somebody to help them out. Yeah, this is a business.
Help people out, definitely. If that's, be generous. This may not be the spot in a business model where you can afford to do that.
Exactly,
if you can, and that's part of your goal, is some people have properties just for people in seminary to live in and to live in free or dirt cheap. Hey, if that's something you want to do and that fits your model, that's fantastic.
But if you're buying this a business, you're borrowing money, you're putting your neck on the line, you're putting your future on the line. You've got to take that emotion
out of it.
And
I can change your gut feeling with one piece of information.
They didn't pay their last landlord.
Yeah, they skipped out and thought that their deposit would cover the last 2 months' rent when it only covered one. And then you're like, oh, now my gut doesn't feel so good.
It's just amazing how these all intertwine together.
You really do. You got to get them right. All right. Okay, number 6.
Yeah.
Neglecting maintenance.
Yes, a stitch in time saves 9.
This is not just for rental property, though, or investors. This is for you as a homeowner.
You told me one time, some people just use their homes. I think about that all the time.
They just live in them. Yes. They neglect them. They don't do a thing to them.
Yes.
And when they go to sell them 20 years from now, it's like, oh, wow, there's so much to do here. They don't have the value. Did their value go up? Sure. Did it go up to the level it could have went up? No. They're leaving a lot of money on the table because the $200, the $200 leak fix that they could have fixed is now become a big moldy attic problem.
Or
right? And now
floor.
It's tens of thousands of dollars and I've seen it. I've seen actually roofs and ceilings in a first floor on a 2-story house cave in because they didn't fix those minor leaks.
You've got to do inspections. You've got to know how to maintain the house, from the simple as changing the furnace filters to making sure the landscaping is right, make sure the drainage is right.
That's right.
Making sure you're addressing concrete that sinks. It's simple stuff like that.
It's just real simple things. So, neglecting maintenance.
Because
it compounds.
Goes back to number 5, doing everything yourself.
Right. So this may be a good model for you. You may want to say, oh, yeah, I can fix, I can repair,
I enjoy doing that kind of stuff, yeah.
Right. But so if you're figuring it in the model, your time has value.
It is. Taken away from your family.
It's maybe taking away from your job, your regular job, or the side jobs you do if you're that handy. Right. So the time is valuable, and you have to, can I really maintain that? So our last one we bought, we thought, okay, yeah, we'll do a lot of the repairs. We did the initial repairs ourselves that we could do, other than calling the plumber or the HVAC guy. But then after that, we decided, you know what, this is going to be a handyman. This is going to be a handyman. And I'm gonna call the handyman. I'm gonna organize it myself. I'm going to still be the project manager, so to speak. But we're not going to go over there and do it ourselves anymore. So it's part of it. Doing everything yourself may be part of your model, and maybe not.
All right, this one was a little interesting. Number 4, ignoring market shifts.
This is important.
Yeah, it is. And we talked about Airbnbs. If you're buying for Airbnb, right now the city of St. Louis does not like Airbnbs. They're passing ordinances. They're making rules. They're going to commercially tax you.
That's right, and that's always been the case. So let's
Yes.
just say you bought a residential building and it had a $3,000 a year tax. Now it's $6,000 because now they're going to consider you commercial. You've got to figure that in. And there are condo complexes, like in Branson, for instance. You got condo complexes, and they're passing the condo complex itself, and they do it here in St. Louis County. May pass like, hey, you guys are using the facilities more, the parking lot, the carports, right? All the exterior stuff. Now, if you're going to rent it, you have to let me know on the first of the year that you're going to rent it this year, and you're going to pay me 1%, 10%, whatever it is, of your rental income for us to help us maintain these parking lots or these gyms or the swimming pool or whatever it is you're using.
You're using it more and differently.
And so this is a shift. Another market shift can just be that, rental rates are going up or down. I know a lot of people who are renting their rental properties at prices that are 15 and 20 years old.
Yeah, I agree. Yes.
Okay,
they got a good tenant. Why mess with it?
So you think ignoring a market shift is a negative thing? No, it's not always negatives. It could be positive. It's like, hey, did you know?
Well, it's negative in that you're leaving money on the table.
You're leaving money on the table. Right. Did you know you could get $2,400 out of this and you're only renting it for $1,200? So you need to keep up with the shifts, good shifts and bad shifts. That's a big deal.
All right.
What do we got?
Forgetting about depreciation and taxes.
Forgetting about, yes. You can, your tax returns are part of your income. You're leaving money on the table if you're not depreciating.
I would say if you're owning rental property, unless doing your own taxes is something you specialize, something you're really into, I would say for most of the people who do that, you need an accountant to do your tax returns.
Well, hopefully you have an LLC.
Right.
That you're that you can limit your liability, and that tenant, if they have a problem, can't go after your personal assets. So now you've got an LLC return to do, and that matters. I have a separate bank account just for that property in that LLC name as well. It's very easy to just print out, and then or just hook it up to QuickBooks, whatever, so that you can delineate all the different maintenance and stuff and get your taxes done very easily. It's very easy for me to do my taxes.
The IRS wants you to own rental property. They give you an advantage.
They give you an advantage,
You get an advantage.
Depreciate. Yeah.
All right,
number two.
Lack of a long-term plan.
Yeah, so again, this goes back to the model. You have to have short-term goals, long-term goals, models for the property, model for the tenant, but the long-term, a lack of a long-term plan is important. Some investors will only keep these properties until they depreciate them. Once they're depreciated, they go on to the next one. Okay, so they're losing money by not being able to depreciate anymore.
Exactly.
Right? And so a long-term plan is very important when we're talking about this. And our number one pitfall that can sink your rental properties, treating it like a hobby. I think Glenn's very familiar with this one.
I am, yes.
Right?
Yes.
Because, Glenn's just like all about the feel good.
Right. Helping people doing that, yes. And not thinking of it as a business and really, hurting your future. You're doing this as an investment. You're planning for the future. This is passive income. Yeah. If you don't treat it like a business and take it serious, it can really sink you, and it can have, you could end up having to sell it, bring money to the table.
Right.
It could just be a nightmare. It can be a nightmare. It could be sitting vacant. It has to be a business.
Right.
You have to take the emotion out of it almost always.
And, read that rental book, Managing Rental Properties.
Or call Angela or call me. I mean, it's just like buying a house. Having a team, people that can support you, give you advice. Early on, we talked about analysis paralysis. These are pitfalls and things to be aware of. There's a lot of people that create passive income that set up for their future by buying real estate, investing in real estate.
They do, and it's a diversification. If you got a lot in stocks and so forth, and you want to diversify into real estate, a lot of people felt that way when the stock market kind of went down a bit, right? And they were like, hey, I want to diversify. What can I do in real estate? And we do. That's one of our long-term goals, is to make sure that we have diversification. And one of my long-term goals is to leave a legacy, a financial legacy, and the appreciation of those properties, and the fact that they're free and clear, and that they're just plain great profit. They're bringing great profit is also part of my long-term plan. It might not be yours, but it's mine.
Well, I would say the other thing, not treating it like a hobby takes a lot of the emotion out of it. It takes the panic out of it. I I can't tell you the people that I know that when, it's the old Warren Buffett, when things were really bad in 07, 08, I knew people that were buying property then. They were buying it at huge discounts because people were panicking, and they probably double, maybe triple their value on those.
Oh, you could buy houses in Brentwood for 30 and 50 and 80 grand.
That are probably selling for 250,000 now.
Oh my gosh, they're selling in the threes.
Yeah, so don't be scared.
Yeah.
Be smart about it.
Be smart about it.
Think about all these. Do your homework.
We have a great spreadsheet. If you're looking for, how do I put all these numbers? Where can I find a great spreadsheet? I'm happy to send that to you. Just, give us a comment or shoot us a little
you
text.
and I both love to do, to talk to people about this, to open your eyes, to look at the possibility. And maybe it isn't for you, but it doesn't cost anything to start the conversation.
That's right. That's right. Well, thanks for joining us today on our investment series. And we wish you all happy holidays as well. Right? So, I'm in my holiday red here.
Oh, yeah, not me. I'm not Christmas yet.
I'm Christmassy already.
So what are we here to do?
We are here to help you build wealth.
Live your dream lifestyle.
And leave legacies that matter. I'm Angela Dillman with Keller Williams Realty Chesterfield, and this is my wealth building partner,
Glenn Calvin at Guild Mortgage.
All right. Have a happy new year.